Charles Hugh Smith is without a doubt one of the most acclaimed financial authors and bloggers on the alternative media scene. In fact, his work often goes viral, hits zerohedge.com, and his interviews on shows like X22 Spotlight and others are well covered. We compiled his most recent warnings, his most critical alerts, his cream of the crop ideas into one exclusive manual at portfoliowealthglobal.com/Smith. On top of this interview, I urge you to download the PDF as it goes hand in hand with Charles's recorded interview. That's portfoliowealthglobal.com/Smith. Enjoy this important interview.
Welcome to the Industry Experts panel at PortfolioWealthGlobal.com. My name is Michelle Holliday. We want to take a quick moment just to bring you up to date about some of our most recent interviews and free reports. We just released a major interview with Gerald Celente. His exclusive report is at PortfolioWealthGlobal.com/Celente. Also, we've released interviews with Carl Denninger, John Rubino, and silver guru David Morgan, who gave us his latest on silver, which is trading at 83-to-1 ratio to gold. That report is at portfoliowealthglobal.com/Morgan. And our epic interview and report with Robert David Steele, where he disclosed bombshell information. That report can be found at portfoliowealthglobal.com/Robert. And of course, Bob Moriarty with his exclusive report at portfoliowealthglobal.com/Bob. And we round it up with our most recent interview releases with the legendary G. Edward Griffin, who exposed some new huge developments at the Federal Reserve. His free PDF report is available at portfoliowealthglobal.com/G. And with that news update, we are honored to be welcoming back to the show one of the living legends of the alternative media financial industry, Mr. Charles Hugh Smith. Charles is the author behind of2minds.com blog. He has written 11 books. He is published on mega financial websites, including Zero Hedge, Peak Prosperity, and the Kaiser Report. Charles helped us to create his own exclusive report at portfoliowealthglobal.com/Smith, where he went into new depths about some highly important topics which he has never publicly shared. Charles, welcome back to the show. How are you today?
Thank you so much, Michelle. I'm honored to join such a tremendous cast of guests that you've had on recently.
Oh, we are honored to have everyone on our show. We have just a stellar group of guests, including yourself. Charles, we want to start off by looking back in time. We're seeing something very interesting happening during the days of the Civil War compared to now. That was about 150 years ago. We saw a financial bubble at that time in railroad stocks and subprime train tracks lending. That might sound a little bit familiar to our audience. That financial bubble burst, and Wall Street, made up of the banks at that time, begged President Ulysses S. Grant to bail them out. In their words, quote unquote, the country will fall apart if he doesn't. But President Grant chose not to help them. So it seems very interesting and sort of a repetitive scenario, Charles. In 2008, modern day bankers once again spread that very same fear, citing the fact that they had somehow once again misplaced all of the money that we had entrusted in their banks, and that citizens would, quote unquote, along with the country, go down in flames if they did not receive bailout money from the federal government through QE programs and otherwise. Charles, what would have happened in 2008 if we would have just let the free market deal with the bank's own subprime problem?
Well, that's a great question, Michelle, and I'm happy you went into the subject with the historical background, which of course is a pattern, as you suggest, that was repeated again in the 1890s and then in the crash of 1929, which was all the same dynamic you described, which was overlending, lending to marginal or unqualified borrowers for highly speculative ventures. And so, of course, the highly speculative ventures usually blow up and the marginal borrowers default, and then the banks are in trouble. Well, what would have happened? It's an interesting question, and many of us were hoping at the time that we'd find out. I think what would have happened is the federal government would have used its power to take over the insolvent banks. There would have been a transfer of responsibility, but the banking industry would have gone on as usual. Every employee would have still been doing their job. It's just that the management would no longer be responsible to the board of directors, and the federal government would have liquidated the defaulted assets and sold them on the open market for pennies on the dollar. And if we want to find a recent example of how this works, we can look at the S&L crisis of the late 1980s, when exactly this same scenario played out on a slightly smaller scale, but it was still huge. Tens of billions of dollars of defaulted loans had to be, and collateral had to be auctioned off by the government agencies, and they did so. And it did cost the taxpayer a lot of money, but the economy was large enough that we could handle it. And I think that's the scenario that would have played out in 2008.
But it seems our educational system sort of wipes that clean. They don't teach about this kind of stuff, so that when people see the repetition or this, here it comes again kind of scenario, what would you say to that? What could change so that we're aware of what's happening?
Well, that is another great topic, Michelle. And this is why I'm so happy that you and your colleagues are creating this content for regular people and giving them access to these people like Salente and your other guests who've written extensively about this, and you're kind of able to summarize these key insights into why our economy is so troubled and why it's so precarious all the time. I think that we are lacking, frankly, at the high school level and the college level in terms of personal finance. In other words, how households can best manage their assets and grow their assets. And that's really poorly explained, I think. I know some schools attempt to do so, and there are some classes in economics and so on, but I think we've really given short shrift to our students in terms of explaining the complexities of personal finance, which nowadays depends a lot on borrowing money, student loans or credit cards, mortgages. And so if we were able to start with personal finance, then that might be an avenue into these larger topics that we're discussing about the dynamics of finance and the entire economy.
I think once people are educated and they realize that this is just a repetitive scenario from people that know history, being the bankers, they get in, they know what's worked in the past. They know that they were bailed out if they lose all of this money or it's misplaced or somehow just gone, and then they become very wealthy. Then the federal government will be so afraid of letting them topple. Unlike President Grant, who just said no. That's just an extraordinary thing in these times. You know what I mean? I don't think that people realize that occurred.
Yeah, that's so true, Michelle. And I think one dynamic we can highlight that's a little different is, Wall Street's always been a dominant force, and there's always been a relatively small number of banks and investment banks. And but in terms of commercial banking, in other words, not investment banking like Morgan Stanley or Goldman Sachs, but just commercial banks like Wells Fargo and the Bank of America and so on that issued, checking and credit card accounts and issued home mortgages and that kind of banking. That industry has consolidated enormously since previous decades. And so you can look at a chart, I think it's pretty common on the internet, where there was once dozens of major regional banks, and those all were bought up and consolidated into 6 mega banks before the 2008 crisis. So that's part of what I think the problem is that capitalism can only thrive if there's a diversity and competition. And so when you shrink the number of players down to a handful, then it becomes like a cartel. And of course, a cartel then controls prices, and there's no real competition. And then when they get in trouble, they dominate the industry, so the entire industry is in trouble. So in other words, if we had 100, like we used to, 100 major regional banks, if 5 or 6 got into trouble, clearly that wouldn't bring the whole system down. But when you only have 5 or 6 mega banks, when a few of them get in trouble, then the whole system becomes extremely fragile. And so that's where the federal government has, the representatives that are supposed to represent the interests of the people failed. The regulators failed by allowing this intense concentration of wealth. And then once you get that wealth concentration, then you get the huge tens of millions of dollars in campaign contributions, and then they buy Congress. So that's a dynamic that I think has worsened since the previous financial panics that we're discussing.
You bring up a great point in that capitalism can only thrive with competition. So when you consolidate huge industries such as banking, you're really attacking the way of life of capitalism, and you're taking it toward what everyone is talking right now about. And there's a rather large fight that's going to start, I think, in terms of socialism, even communism, entering the ideals of the people that are making the laws right now. So that's a really scary and important point for everybody to think about, that the consolidation of those banks is an attack on capitalism.
Precisely. Very well said.
Yes. Now, Charles, turning now to the battles of central planning, we know that the top 10% of U.S. households now own 90% of equities. So they obviously want lower interest rates as long as they can see them happen. The average person would like nothing more than higher interest rates, even if he doesn't know it, since it makes the government more frugal and gives savings higher yields, and mostly it will deflate the prices of everything for everyday items. Thirdly, the global economy is slowing down, so the Fed is desperately fighting higher precious metals prices. Has the Fed lost all credibility with the decision to pause? What are your thoughts?
Well, that's also a highly stimulating and controversial question because, as you know, and most of our listeners know, the general take is the Fed caved in and surrendered its responsibilities to the larger economy to prop the stock market back up. And there's certainly some element of this. It's so obvious. It's really undeniable. And we can maybe go back to 2009 when the S&P 500 was at famously 666, almost exactly 10 years ago. And now it's pushing 2,800. So you've seen a tremendous increase. I mean, a quadrupling of stocks, while the real economy, as measured by GDP, has gone up around 43%. So you've seen this incredible asset bubble in stocks as a result of that super low interest rate that you've described. And so if we think back now, over kind of historically to the good days of, say, the 1960s or so on, mortgages were higher than they were now. You maybe 5% or 6% was considered normal. And when inflation kicked up in the 80s and so on, then it was as high as 10 or 12% was normal. And so we're at really abnormally low levels of interest rates and yields. In other words, this is unprecedented. And so we have to think, well, why has the Fed been obligated, or why have they chosen to keep interest rates at levels that are below the best times the economy's had in the last 70 years? And it must indicate that they're fearful, right? That the economy is more precarious and more fragile than they're letting on. And so they have to keep interest rates really low. But as you point out, there's a cost to that. Pension funds can't earn enough money now. And at low interest rates, as you say, have created bubbles in stocks and houses. So a house that might, historically be worth $200,000 is now $400,000 and therefore unaffordable. So there's a lot of unintended consequences to that super low interest rate policy.
Charles, are we at a point where issuing debt cannot stimulate the economy? Is free money not even worth the free price anymore because debt is becoming so dangerous for balance sheets?
Well, I think your question is really timely because we're piling up debt at a tremendous rate, both at the federal government level, private debt, and corporate debt. Right? Everyone's borrowing like crazy, essentially. And this is global, of course. China has created huge amounts of debt that, their economy went from 7 trillion in total debt, public and private, in 2008 to like 40 trillion now. So we're not the only ones borrowing like mad. And you bring up 2 points. One is debt, sort of what I call debt exhaustion. That, when there's very little debt in the system, if you borrow $1 and spend it, you're going to get a big boost in GDP. But when you've already borrowed heavily, then borrowing and spending another dollar doesn't really do much. And that's where we're at now. So there's that element that borrowing and spending no longer generates the returns it did early on. And the other issue is the tremendous size of debt. And again, I like the fact that we're bringing history in. And if we go back to the period when interest rates went up a lot, the late 70s and early 80s, when Fed Chair Volcker had to raise interest rates to control inflation, the economy suffered. That auto sales and housing dropped as interest rates soared, but it was doable. In other words, the economy had a sharp recession for 18 months or 2 years, and then it recovered and grew strongly for decades. Now you have to ask, could we survive if interest rates went back up to historical levels, like a mortgage might be 6, 7, 8%, and a bond yield might be 5 or 6%? Could we survive? And then the answer is probably not, because there's so much debt out there that doubling of interest would drive a tremendous number of households, corporations, and local governments, into insolvency, default.
It's so interesting that prices are so inflated right now that a person, if interest rates went up to 10, 12, 15%, so that you could really make a lot in your savings because of interest rates, then homes would be just completely out of the question, any borrowing, because it would be so huge simply because of the prices now, correct?
Right. And so there's we can imagine it's like a seesaw, that if mortgage rates doubled or even went up 50%, from 4.5% to say 7%, the price of the house would have to drop by a comparative amount in order to be affordable to the vast majority of people. So a house that's $500,000, if interest rates go up 50%, it's going to drop by at least a third just to become affordable. So that you're right, that the housing bubble and the corporate bond bubble and a lot of bubbles would pop with higher interest rates. But as you said earlier in the program, wouldn't this actually benefit the vast majority of people? And the answer is yes, by reducing the cost of these assets and reducing the price of everything in the economy, so-called deflation.
Exactly. And then also, because we take such a hit on our savings account, you can't earn anything if you have savings in the bank. In fact, they're talking about negative interest rates, which is happening throughout much of the world.
That's right. I just saw some number. I mean, there's something like, several $100 billion in negative interest rate bonds in Europe and Asia. So, again, I think the larger topic here is, how can our leadership, our elected leadership and the private sector leadership, how can they improve the situation so that the system works for 90% of us instead of 10% of us? Exactly.
Now, Charles, how do you envision what the next recession and global depression might look like? Many people have been drawing so many pictures in their minds. From your perspective, how bad could it become?
Well, I'm so happy you asked that question, because I've spent a lot of time thinking and writing about that recently. And my sense is that the vast expansion of debt that we've discussed and the diminishing returns on that debt mean that the coming recession, whether it starts this year or 2020, will be deeper and more prolonged than the last several recessions. And the reason why I think this is that number one, many people alive today have never had a real recession. They've never lived through a recession like the one in 81, 82, which was very severe, sharp spikes in unemployment and a lot of suffering throughout the economy. The recession of 1990 to 91 was rather brief and shallow. The recession in 2008-9 was also rather brief and shallow. It hit people who were exposed to the subprime mortgage situation and so on. But in general, it was rather quick because the Federal Reserve was able to take these very aggressive actions, lowering interest rates to zero, flooding the economy with liquidity and so on. My idea is they're going to do that again because that's what's worked in the past, but it's not going to work this time because the economy has changed. There's too much debt, and just trying to get people to borrow and spend is not going to work anymore.
So what do you think is going to happen? Because that is pretty much the consensus, that they're just not going to be able to do it again.
Right. And the reason why it's a consensus, at least in the alternative financial media, is that if the conditions change, the strategy has to change. And so the conditions have changed. So just repeating the same strategy is not going to work. And so what I envision, and a lot of other people think the same thing for similar reasons, they'll lower interest rates to zero, maybe try to force everybody to borrow and spend by even pushing interest rates negative, like we were talking about, where you'll get a minus 0.1% on your bond instead of a positive yield. You'll actually lose money buying a bond. And the idea here is to force us to spend our cash to boost the economy, right? But if everybody that's qualified to borrow more no longer wants to borrow more, then the only borrowers out there for lenders to go to are the unqualified people who will default very quickly. And that will lead to another banking crisis, because if the only people who want to borrow are unqualified and speculative borrowers, that's just setting up another crisis of default. And politically, I think the winds have changed. The public is no longer willing to rubber stamp the bailout of speculative lending and banks. And so I don't think they're going to be able to repeat the 2008. So I think what will happen is they'll lower interest rates to zero again. Nothing will happen. The economy will deepen, and the recession will deepen. And then they're going to go crazy by issuing free money, whether it's called the new Green Deal or universal basic income. Give every household $1,000 a month. They're going to do something really drastic like that, and that's going to create inflation. And unfortunately, as we discussed earlier, we can't support a higher interest rate that's going to come with inflation anymore, because if you get over indebted, you can't afford that higher interest payment. And so the Federal Reserve and the other the government agencies, they're going to basically trap us in an economy where they can't raise interest rates, but they've created inflation. And so that's going to hurt everybody, because of course we all know what happens with inflation. The $5 sandwich now costs $15. Right. And that means we all get less for our money.
Right. Venezuela is something, we always talk about here. It's a huge subject throughout the entire world. President Trump is talking about it. They're trying to handle it, but we're going down that road. And people are like, well, I have $40,000, outside of the bank. It won't affect me. And it's like, not when you wake up and that buys you 4 loaves of bread. You know what I mean? And it just happens so fast with Venezuela. So people really need, and if those 4 loaves of bread are in the grocery stores, that's what they're facing.
That's right. And, Michelle, I'm sure that many of your, viewers and guests have said, people don't believe this can happen in the U.S., right? We're the biggest economy. We have the strongest currency and so on. But I can tell you, because I was alive at the time, inflation, once it starts kicking up, which it did in the late 70s and the early 80s, it is devastating. 10% a year. Well, in 5 years of that, that's 50+% decline in your purchasing power. So it adds up very quickly. And what I'm trying to describe is how we've boxed ourselves in to where the solution that was to high inflation in the past was to raise interest rates a lot. And that's the only way to suppress inflation once it kicks in. So that solution is no longer available to us. And so that's what's terrifying about the Venezuelan model that you described, that the government in Venezuela stripping away all the ideological, things that people talk about now. What they really did was they just kept printing money to spend it to fulfill the promises that they'd made. And so that's it's a political trap, right? You've made promises, you got to keep the promises, so you print the money, and then you end up destroying your currency.
There it is. There it is. That is the bottom line nutshell of it. And if we continue to allow our government to print money, that's why this Green Deal is such a catastrophe, and to support that and to not realize that all they're doing is printing money to make that happen. And we're headed toward a cliff, and we're driving in the dark, and we don't know when that cliff is going to hit. You know what I mean? You don't know where it's at, but when it hits so fast. And that's what's terrifying to people that know this.
That's right. And the fact that patience is required. In other words, people who understand this and decided to buy hedges, which, in other words, things that will be sort of inflation proof, like precious metals, then of course they've gone nowhere for 5 years, and everyone who invested in these bubbles has made a ton of money. And so, it's hard. The timing is very difficult. And so you have to, if you're going to hedge your wealth, you have to kind of buy the hedges and forget about it, because you can't, it's very difficult to time when the bubbles will finally pop.
Speaking of hedges, talk to us about what we should be doing.
Well, you've had a lot of terrific guests on who know the precious metals markets, and they understand that the catastrophe that the Fed policy is going to lead to better than I do. But I think that the basic idea here is, if the government can inflate its currency in order to solve some political or financial problems, it will do so, right? It has the power to do so. So what you want is an asset that the government can't inflate away. And so this is, of course, traditionally gold and silver, and maybe platinum and some of the other metals. And more recently, a lot of people are believers in cryptocurrency. And I've written a lot about this. And, I understand people's reluctance to buy into the cryptocurrency story. But I think that the reason why a lot of people are interested in cryptocurrencies is for the same reason. It's an asset that the government doesn't control and can't inflate away. And so that's kind of what we're looking at. And of course, obviously, things that are in the material world, like, farmland and tools and that kind of thing, they tend to survive inflation, right? They're still here after the bubble pops and there's a new currency. And this is speaking of that kind of scenario, what usually happens in hyperinflation or very high inflation is the government then announces a new currency, right? And so 1,000 of the old dollars is now $1.
Right.
And so that's the kind of thing. And so and in my analogy is, if you have a saw or some kind of tool, it might be worth $100,000 at the top of hyperinflation. And then after the currency's, relaunched, it's worth $1. It still provided the same value to you, whether it was worth $1 or $100,000.
Right,
so that's the kind of thinking I think we can pursue.
Yeah. And what people don't realize, because they've never lived through it, is literally, $40,000 can buy you 4 loaves of bread. It's literally, you think that you're safe because you've got this tucked away, but not if your government prints money to the point where one day you wake up and it's worthless. One day you're fine. Wednesday you're fine. Thursday, it's all over. And what do you do? So switching to politics for a moment, Charles, do you think that President Trump is a shoo-in for 2020?
Wow, no, that's a provocative question.
Here you go.
My personal opinion is, and this is not related to his ideology or even his character, but just to kind of past history of presidents, is, President Trump is not a young man. He's not a President Kennedy or a President Obama. He's not in his 40s or early 50s. And I suspect he may just tire of the tremendous burdens of being a president, right? Which we all know by looking at photos of presidents. When they enter office and when they leave office, they're pretty beaten up. Whether they're Democrats or Republicans or independents, it's a tremendous amount of responsibility and burden. So it wouldn't surprise me if President Trump decides to leave on a high note and just decides not to run because of health issues, or just he's tired of it, and so that's a possibility that I don't see too many people talking about.
Well, you know what? I just did an amazing interview with Robert David Steele, and he said exactly that. He shocked me. That was the first person that I've heard actually say that President Trump might not run in 2020. And I was like, what? So you really think that's a possibility also?
Yeah, because I think if we say anything about President Trump's character is, he's an independent guy. In other words, he's not going to do what somebody tells him to do. And so, if he decides I've had enough, then we can be pretty confident that he's out. And he may feel that he's done all he can. And there's something to be said for that, right? That you've done all you can, and you don't want 4 more years of all the drama, trauma, and stress.
All the attacks. I know a whole lot of people that would be really upset with that notion. So let's hope he runs. Staying on the topic of politics, are you worried about the wealth gap and the rise of populism?
I'm not worried about the rise of populism because it's a rational response to the rise of inequality. And, I think we can simplify this in that the economy's no longer working for the bottom 90%, right? And so what's our response when it's no longer working for us? Well, we're going to protest in some way. And so we're going to vote for the alternative candidates. We're going to make it known that we're not happy with the fact that our standard of living is declining, not going up. And, I would summarize this like, the GDP went up 43% in 10 years. Are you 43% better off? And the vast majority of Americans are going to say no. Their money buys less, and they didn't participate in these huge asset bubbles. And or even if they did, and their house is worth twice as much, it's not really changing their life for the better because their medical bills are higher, their college tuition is higher, and their living expenses are higher. So populism is I think it's a term that the media is using to denigrate the protest of the average person. And populism is just another, I think, a term for, I want to make my voice heard, and that I want some kind of true representation of my interests. And that we call that populism. And in that sense, it's a good thing.
Exactly. Something that's been ignored for a while. Now, Charles, how does China fit into this overall picture? In your view, will China rule this century? And if so, what do you make of their incredible challenge with the one child per family policy? It's caused a situation, hasn't it? They have a huge number of retirees, over 330 million, without enough working people now to support this. What are your thoughts?
Well, you've just summarized it in a nutshell that China will not rule the 21st century, and the reasons why, we can go through them very briefly. One is, as you say, demographics, that once your working population starts shrinking, which is already happening in Japan and Italy and low birth rate countries, and China's online to be next because of the one-child policy, and that more recently, it's become very expensive in China. That it's not a cheap country to live in anymore. And I hear this from our Chinese friends. Now, I visited China, and I have friends who live there. I have friends who went to college there. They're Chinese nationals, and they live in Europe or elsewhere. So I think I have some pretty good on-the-ground intelligence that the cost of living is really high now. So a lot of younger Chinese households are not having a lot of kids because it's too expensive. Just like here, you have one child because that's all you can afford, and you have to be pretty well off to have two. And so we can't, what I'm saying is we're not going to see some gigantic birth bubble in China that's going to solve their demographic problem. That's the thing about demographics, is it's already wired in, right? You can't change the number of people who are going to enter the workforce in 5 years. And so China's got the demographic problem. They've got another problem, which is a great many of their people in the West are still very poor. they make, $50 a month or $100 a month. And, this, in other words, it's not a uniformly wealthy country. The coastline and their upper middle class is wealthy, but hundreds of millions of other people are not yet at that level. So they have a lot of public cost if you're going to try to raise the living standards of those 5 to 800 million people who are still impoverished. The other thing is they've had this huge upsurge in debt, which I described, from 7 trillion 10 years ago to 40 trillion now. So now they're facing the inevitable results of that. A tremendous expansion of debt and malinvestment. Defaults, corporate defaults, slowing growth, decline in lending, all those things that come as a result of that. So even though they're a central planning economy, they've succeeded in their rapid growth was dependent on freeing certain parts of their economy to the public, to capitalism, essentially, right? And so they now have the worst of all possible worlds. They have all the inefficiencies and malinvestment of central planning, and they have all the consequences of a speculative bubble in the private sector. And there are no solutions to both of those issues.
Man, it's just amazing when you look at the whole world. It's like, look what's going on there. Well, look what's going on there. The United States actually looks pretty good in comparison to that, as long as we can rein in our problems. We got to recognize it before it becomes insurmountable. I think that's the challenge.
That's right. No, that's right. We have a much more stable and more diverse economy and society than most other countries. So we have a good foundation if we don't destroy it with over-indebtedness.
If we don't allow our political leaders to destroy it, we've got to take control of this. Charles, it is always amazing to have you on this show. Please tell everybody about your books and about your blog and what's coming up for you in the near future.
Well, thank you for that. My latest book is called Pathfinding Our Destiny, and it's about saving our democratic republic. And it deals more with finance and the economy than with politics per se. Like, I don't think politics is really the solution. The solution is, as we've discussed on this program, and I go into that a little bit more in that book. And then you can visit me at of2minds.com and read sample chapters of my books and tons of other free stuff.
Amazing. Thank you so much for coming back on the show today.
Thank you for the excellent questions and topics, Michelle.
Excellent. Mr. Charles Hugh Smith, expert in the alternative media financial industry and who goes in depth in our exclusive report at portfoliowealthglobal.com/Smith. For the Industry Experts Panel, I'm Michelle Holliday at portfoliowealthglobal.com.
In March, we've already released a no-holds-barred interview with Bob Moriarty. He really went hard on Alexandra Ocasio-Cortez. You can go to portfoliowealthglobal.com/Bob for the details. We also plan on releasing one of the bombshell interviews of the year, conducted with David Stockman. In the month of February, we have released a worldwide scoop with G. Edward Griffin, the 87-year-old best-selling author who introduced the world to the banking cartel, and has published with us the portfoliowealthglobal.com/G Critical Federal Reserve Update. We also just released interviews with the man who exposes the deep state and the shenanigans of Washington better than anybody else, Robert David Steele, and I highly suggest going to portfoliowealthglobal.com/Robert. Of course, for the most accurate information on Charles Hugh Smith's latest and best, go to portfoliowealthglobal.com/Smith. It's essential reading.